In the last few videos, we have talked about how we can derive the aggregate supply in the Keynesian model in the short run, or at least in the very short run, and how the sticky wages and inventories, excess inventories, can play a role in that. We've also discussed that in the long run, the Keynesians argue, or the Keynesians also believe, that we should theoretically reach our theoretical output in the economy, which is in line with the classical model of aggregate demand and supply. We've also derived how we can, we have also looked at how we can derive aggregate demand in the Keynesian system. So if you haven't watched those videos, please make sure you watch those videos, otherwise you're pretty much not going to understand anything. When it comes to long aggregate supply in the Keynesian model, the shape of the supply curve looks something like this. Previous videos we have discussed this first part where the supply curve is completely horizontal. We have also discussed this third part over here where the supply comes back to the vertical, which is in line with the classical model. But I did not go into detail when it came to the second part, which is essentially the point where the curve, where the supply curve goes from the short term to the long term, the transition between the short term and the long run. How do we understand this transition from a Keynesian perspective? Because it requires an understanding of the labor market. So I expect you guys to have at least a basic knowledge of how labor markets work, at least in the classical system, so that you can follow along as I explain. When it comes to this transition effect from the short run to long run, if I can, let's see if I can do that. If I can draw this separately, the curve looks something like this. As the GDP is increasing, our prices in the economy are also increasing. So how do we understand this from a theoretical perspective? For this, we have to first take a look at what is the meaning of the word aggregate supply. What does long aggregate supply essentially means? When we talk about aggregate supply, what we are trying to say is how long or theoretical potential of the economy. If we employ all the factors of production, if we employ land, if we employ labor, all of it, if we employ all the capital in the sense the machinery, the equipment, if we employ all of them, if we employ all the enterprise refers to the managerial perspective or the managerial aspect of the business, we should reach this theoretical output. In the short run, because the Keynesians mainly talk about the short run, in the short run, when it comes to enterprise refers to all the managerial roles in a company. And in the short run, if there is any boom in the economy, or if there is a depression or recession in the economy, the management is not changed significantly. It's not like the CEO will fire all the board of directors and all the chairmen and the entire management would change. It's not like that. In the short run, the enterprise doesn't really change a lot. Capital and land also doesn't change significantly in the short run, because if, let's say, I have a factory and for some reason there's a recession, let's say for some reason we have a natural disaster like Corona, as I'm recording this right now, can the company sell all of its land and sell all of the equipment? Yes, it can do it theoretically, but it will take him at least around 2 to 3 years to get it done completely. So when we talk about factors of production, in the short run, the only factor of production that is really affected is labor. As a factory manager, if there's a recession, it is very easy for me to fire or hire a few extra laborers, or if I want, I can completely shut down the plant for a few weeks. When we talk about the transition effect, we always talk about labor markets because it is the labor that is impacted the most. At this stage, if you're watching this video, you're most likely a university level student. So I expect you guys to have a very basic understanding of labor markets. As I won't be going to that into a lot of detail, I'll make future videos and probably link it up in this video too, in case you don't understand how we can derive the labor market demand and supply. But to keep things simple, I'm going to make an assumption that you guys already have the knowledge of aggregate supply, of the labor supply and employment in the economy. To keep things very simple for this video, just understand that the demand for labor is derived from marginal revenue product. Marginal revenue product essentially means how much revenue I'm gaining for every single extra employee that I am employing. Whenever our wages meet, or wherever our labor supply intersects the marginal revenue product, that is the point where the companies would employ the amount of labor, and let's call that point N0. Let me explain that with a very simple example. Let's say that I employ 5 laborers, and let's say those 5 laborers are producing me, let's say 10 units of product, and let's say each unit is worth $1. So those 10 units should theoretically give me around 10 into 1 should give me $10. Let's say that I employ 3 extra laborers, so now I have a total of 8 laborers, and let's say they are producing me a total quantity of 20 units. So we will have a total revenue generated would be of around $20. For me, by employing 3 extra laborers, those three extra laborers are giving me a total product of 10. My product has increased by 10 by employing those 3 extra laborers, and my revenue has also increased by 10. So to calculate marginal revenue product, all we have to do is multiply our price, which is in this case $1, or the marginal revenue, which is in this case $10. $10 multiplied by your marginal product, which is also going to be in this case 10. Is it? Yes, it's 10. So we are employing 3 extra laborers, and those 3 extra laborers are giving me 10 extra product, and they will cost me, or the revenue that I will generate is going to be 10. So this will give me a total revenue product of $20. To keep things simplistic, just know that the formula for marginal revenue product, marginal revenue product is equal to marginal product, or MNP or MPN, however you like to put it, multiplied by the price of the product. The shape of the MRP curve and the shape of the MNP curve are exactly almost similar, so don't get confused when you will notice 2 similar graphs with the same shape. Generally speaking, they have the same trajectory, so it should not be a problem. All of this you'll probably study in basic labor market analysis, but if you haven't done so, I'll make a few videos and I'll link it up in case you guys require an explanation. When we talk about the transition from the short run to the long run, as prices increase, our output or GDP is increasing. So what would happen if prices increase in the labor market? Because we have to assume that in the classical and also in the Keynesian model, firms are perfectly competitive. So whatever is the price of the market is going to be the same price or the same wage paid for the firm. But also you will notice that if the price increases, our revenue product would also increase. So if we take an example, let's say in the previous example our revenue product was, let's say 10, and let's say we have the price of each good is 5, and let's say we have 2 laborers. Let's say for some reason the price doubled, for whatever reason the price is doubled. So now we'll have 2 laborers. Because the prices have doubled, we will have a revenue product of 20. Let's assume that this point over here represented 2 laborers, and let's say this point over represented 10. What's going to happen when the prices increase? When prices increase, our revenue product is going to shift towards the right. So let's say that this point over here represents 20. So as the revenue increases, our MRP curve shifts towards the right. If the prices increase further, our MRP will shift further towards the right. So what's happening to labor when our MRP is shifting to the right? So what is happening to our MRP as our prices increase? The MRP curve shifts towards the right, and this causes a new equilibrium point to be created at a much higher price, at a higher wage, with a higher amount of, let's call it N1, let's call it N2. The curve seems a little bit scribbly, but I hope you guys get the point. Whenever the MRP curve shifts towards the right, assuming wages are constant, because if you think about it, in Keynesian economics, at least in the very short run, the wages are sticky, but we will not get into that aspect right now. Just keep in mind, whenever the MR curve shifts towards the right, we will have more labor being employed in the economy. So how would that impact the GDP in the economy? Whenever we have more labor employed in the economy, that will directly affect the production function. So if I can draw a production function quickly. Production function is an upward sloping curve. Production is equal to and we have labor. So we have GDP on the x-axis, and we've got production, let's call it production over here, production on the x-axis. So let's say that this point over here was an initial level of employment, let's call it N0, sorry, Y0, and let's say this point was our initial production level, let's call this N0. As the employment increases, our GDP in the economy, or the total output in the economy, would also increase. You can either have employment or production on the y-axis. Both of them essentially have the same meaning because they have a direct relationship with each other, so it should not be a problem. So when the employment rises from N0 to N1 and N1 to, let's call it N2, our total GDP in the economy is increasing, and that goes back to our, let me just zoom out over there, that goes back to our initial curve, that whenever our prices increase, our GDP in the economy would also increase, and essentially this would give the upward sloping shape of the supply curve in the Keynesian model. To quickly summarize it again, just keep in mind that the Keynesian, let me just zoom in, the Keynesian model consists of the Keynesian supply curve consists of three distinct parts. We have the part where the wages are completely sticky and we have a lot of excess inventories. We have the transition part, and we have the long run aggregate supply part, which is essentially in line or same as our classical model. Why do we have an upward sloping transitional curve? That's because whenever we have an increase in prices, those increase in prices will cause an increase in employment, and that increase in employment would cause an increase in production, and increase in production would theoretically cause increase in GDP, or input in the economy, or the output in the economy, and that should increase our GDP in the economy. In the next few videos, we'll talk about how we can derive the labor market and how labor markets derive in the Keynesian model.